What's up guys, my name's JJ and welcome to the video. In today's video, I'm going to be teaching you guys how to trade options as a beginner. We're going to be doing a very basic, elementary, step-by-step walkthrough on the Robinhood app to show you guys how you can get started by trading options. Now before we get into the video, for today's beer, I got a Parkside Pineapple from one of my favorite breweries here in Missouri, 4x4, has a 6.5% alcohol content. And I'll be honest with you, this is one of my favorite IPAs here in the Missouri area where I live. And cheers to 4x4 Brewing Company, as well as you guys for watching the video. So without further ado, let's jump into it. Alright, so this is the Robinhood investing app. This is my actual portfolio that I have with Robinhood, and I chose to use Robinhood today because, one, it is my personal favorite investing app to use for not only trading options, but also to invest. But I've also tried out many different apps whenever it comes to trading options, and I always come back to Robinhood because they are the slickest, best user interface, easiest to use, and it's just overall nice to trade options with. I mean, really, when it comes down to it. So you can see here, I even have an options contract open currently. It's a SoFi Leaps I purchased a bit ago, and we're not going to talk too much about that. Maybe that's Leaps for a whole nother video. We're talking about the basics here. We are going to go into how to trade options for beginners using the Robinhood app. So for today's example, I'm going to be using a stock I own in my Robinhood portfolio, and that is SoFi. So if you are trying to find how to actually start trading options on Robinhood, the first thing you will click is the stock that you want to trade options with. So again, we're using SoFi. We'll click SoFi, then you can see this trade button down here in the bottom right hand corner. You'll click that, that'll pop up at trade options. You can either then choose to sell or buy that stock if you have ownership in that stock already. If you don't, it'll just say trade options or buy. So since we're talking about options today, let's click the trade options at the top here. After you click trade options, you'll see this kind of help sheet of Robinhood pop up. If you want to read it, you can, but for today's video, we're just going to skip right through this. So these dates up here up at the top are known as the expiration dates. Those are whenever your options are set to expire. So the farther you go out, typically the more expensive the options get to be able to purchase or to sell, so your premium is higher. Now all of that may sound confusing, but don't worry, we'll get into it. Now real quick before we jump into this, guys, I do want to let you know I have an actual options course down below in my description. You guys can click on. If you guys sign up today and use code OPTIONS, you'll get 50% off that course. If you guys want to go a little bit more into detail after you've watched this video and you feel like you got a better understanding, I go into the Greeks. I also partnered up with I would call him maybe even an options expert, with my buddy here on YouTube, Brad Finn. We joined together and we built this course, and we've had many different students go through it and have nothing but good to say about it. So again, use that code OPTIONS for 50% off if you guys want to check out the How to Trade Options Beginners course down below in my description. Now, what we're looking at here is known as the options chain. This is where you get a list of all the options you can choose to buy or sell for any given stock. So again, what we're going to be talking about to make this video not get too crazy and kind of take many different tangents, because it's very easy to do that when it comes to trading options. You can see these four little tabs up here. You see buy, sell, and then you see call and put. So I'm going to be talking about each four of those options. You can either buy a call or you can buy a put. And then you can either sell a put, you can also sell a call. So I'm going to be talking about all four of those options and whenever you can choose, or when you might want to choose when to do that. So first, let's start with buying a call. So generally you'll want to buy a call whenever you think the stock price is going to go up in value. So let's say, for example, we have earnings coming out on SoFi, and I have a really good feeling that SoFi is going to be beating their earnings, which in return will most likely raise the stock price. Well, again, that's a very, very risky thing to do whenever you're betting on earnings play, because what it is, it's a complete gamble. No one knows. But over maybe, let's say, a month's time, if you think that SoFi price will go up in a month's time, let's go out a month, let's say December 9th, then you can choose to buy a call on SoFi. And basically what this does is this gives you a bigger chance to earn more capital gains with a less amount of money invested up front. So if I wanted to go buy 100 shares of SoFi, SoFi is currently trading around $5.50 right now. That cost me $550. But if I choose to buy an options contract of SoFi, it may only cost me, if I buy one contract at the $6 strike price right here, it cost me $32 to do that. So it's a lot less capital up front that may be able to have that same return on investment that you would if you would have had to put the $550 down on the actual SoFi options. And when you are buying options contracts, it can get very risky at certain times, especially if you're going way above out of the money, meaning the farther you are away from the current share price, the higher you go up, the cheaper you can see these premiums right here. The higher you go up, the more risky and generally more volatility you're going to see whenever you're buying those types of calls. So again, plain and simple, when you're buying calls, you think that that share price is going to go up in value. But if I'm buying calls, I am buying calls that are in the money. This helps out with volatility as well as risk. So when I'm looking at this, I may buy something I may buy the $5 strike price here. So the $5 strike you can see on the December 9th expiration date would cost me for one contract would be right around currently $93, and that is based in between the bid and ask price. You can see the bid price would be 0.89, the ask price would be 0.97. Now I may type $93 in here, and I may not get that this trade may not get executed. I may have to go up closer to the ask price of $97 if I want my actual purchase order to execute right away. That's just kind of depending on the bid and ask. But again, there's so many tangents you could go down. Let's stick to the bread and butter here. When you are wanting to buy a call, that means you think the share price is going to go up in value and your trade will become profitable if that share price does go up in value. Now, in the money. In the money means that the strike prices are below the share price when you're buying calls. So this $5.50, the $5 strike, the $4.50, the $4 strike are all in the money. Now, at the money would be right at the share price at $5.80, but there's no strike prices at $5.80. But close to at the money would be $5.50 or $6. That's pretty damn near close to at the money. Now, if you are out of the money, which tends to be a little riskier when you're buying calls, would be the $6.50, $7, $7.50, and so on strike price. So again, to recoup here, when you think the strike price is going to go up in value, you buy calls, and after you purchased your call options, if the strike price does go up, you will gain profit in that trade. Now, what if it's the exact opposite? What if you think a company you're looking at is just doing horrible? It's been quarter after quarter, it's been having worse and worse earnings, and you think that share price is going to continue getting lower. Well, then what you can do is the exact opposite of buying a call. Now you can buy a put. So if I own SoFi here and I think that the share price of SoFi is going to go down, well then I can buy puts in SoFi. That's meaning I will have a higher return if the share price does go down in value. Now, if the share price goes up in value after I purchase my put, well then I lose money. I am losing money on that trade. So these are all risks you need to be aware of. But if I think the share price is going to go down in value, then I can purchase puts. Same thing happens here, except it's the exact opposite. So in the money options would be the above share price, because I think if the share price is going to go down more, well then in the money would be above the share price. So 6.57, and then out of the money would be below the share price whenever I'm purchasing puts. So it'd be the $5.50, $5, $4.50 strike price. So let's say we're in here going to make a trade and we think that the share price of SoFi is going to go down in value and we're feeling a little risky and we want to maybe get a little bit more bang for our buck, although we're willing to take the risk and lose our money 100%. Any options trade I go into, especially buying options, I plan on losing that money 100%. I tell myself, if I lose all this money on this trade, am I okay with that? And I feel like any one of you, especially being beginners, you guys need to tell yourselves that as well. Don't get too far in over your heads. Start with a little amount of money to learn the game and be prepared to lose money. That is the first thing I can tell you. Make sure you're okay to lose the money you're using to invest when you're buying options. So let's say we think SoFi price is going to go down in value and I want to buy this $5 strike price. So what we do here is we click on this, and currently the limit price set, there's a bid of 12. The bid ask spread is there's a bid of 12 and an ask of 14. So in the middle would be that $13 price, and I would probably most likely get this trade executed. Let's say I wanted to come in and I wanted to buy 5 contracts of this. Now each contract you purchase represents 100 shares. It gives you the option to purchase 100 shares with every contract you purchase. So again, 5 contracts we're going to put here. We're going to go ahead and set it at the limit price of 13, which is what Robinhood is recommending, right in between that bid ask price. So that would be a total max cost from us for $65. Now, how we came up with $65 is because, as I just mentioned, every contract represents 100 shares. So then you can see here this max cost is figured out by taking the limit price you agreed upon, or what you're going to try and get that trade executed at. For us, it's the $13 or 13-cent price. So we take those 13 cents and we multiply that by how many shares in this contract we are looking to purchase. So the contracts, we have five times 100 contracts. Each contract represents 100 shares, so 5 times 100 gives you 500, and then you take your limit price, which is the 13 cents times the shares. It's giving you that $65. So we can come back up here and we can go back to 1. Now we have $13 we're coming up with, because the 13 limit price is multiplying by those 100 shares, because it's one contract, giving you $13. So if we did 10, that'd be $130, because it's 13 cents times 1,000 shares. I hope that makes sense, but that's basically how that works. And you click review, and if I wanted to move forward with this trade, which I'm not going to do that in today's video, I would simply swipe up and wait for that trade to be executed. So let's go back here. So we've talked about buying calls. That is whenever we think the stock price is going to go up. After we've purchased our contracts, if the stock price does continue to go up, well, then we will be making money with that trade. The exact opposite is when you're buying puts. When you think the stock price is going to go down in value, you can purchase puts. And after you've purchased those contracts, if the stock price continues to fall, well, then you are making money in that trade. Now let's move on to my favorite strategy whenever we are trading options, and that is selling options. Now, I have whole videos dedicated to selling calls and selling puts. You guys can find them here on my channel. This is my favorite way to trade options. I don't tend to really buy options very often. I will every now and then if I have a good hunch or have a good feeling about something, or if I see something in the market happening. Usually I'm selling calls and selling puts. So let's go back to my SoFi position here. I own 500 shares of SoFi in this portfolio. So that's important when it comes to selling options, because with selling options, you have to have some sort of collateral up to 100 shares. So let's say, for example, we want to sell calls. Selling calls means that you are willing to sell your 100 or more shares in increments of 100 at a agreed upon price. So I have 500 shares of SoFi. Let's say I am okay at selling. So let's go back to look at my position here. My average cost is $7.73. That is where I break even at my ownership of SoFi. So if we go back to trade options here, and we go back to about a month out, we have sell selected and call selected. So we are selling calls, also known as selling covered calls. And my average price was $7.75. So let's say I was okay at letting go of my 500 shares at $8. So at the $8 strike price, I said, okay, if SoFi gets to $8 or above by December 9th, I am okay in selling my 500 shares of SoFi. Now with that, with agreeing to that trade, I am actually going to earn money from these credits. So you can see here, this limit price here is now not what it cost me to make the trade. Now this is what I'm getting paid to make the trade. So if I come in here and I click 5 contracts, and again, bid-ask spread, if you're selling options, you typically, if you want you want this to get filled right away, you have to go more towards the bid price. So let's say we're just going to stick at the 2-cent mark here. And again, same thing for the credit would be the 2 cents times however many shares you're working with. Mine would be the 500 shares, and that would give me a premium or a credit of $10. So that means that is what I'm going to get paid for saying I'm willing to sell my 500 shares at the $8 strike price. So I've earned $10. Once I click review and swipe up, if I would choose to swipe up and the order gets fulfilled, I automatically right away get this $10 directly into my cash account. So let's say I wanted to be a little risky, and I do not recommend this by any means, but let's say I wanted to say I'm willing to sell my 500 shares at the $6 strike price, and let's assume my average price was at the $5 mark. So I would never really recommend selling covered calls below your strike price or below your average price. I mean, you can do that, but it's very risky, and I would stick away from it unless you know exactly what you're doing here. So if we come in here, at the $6 strike price, we do the 5 contracts because I own 500 shares. And again, for selling covered calls, you have to have collateral. So for me saying I'm willing to sell those 500 shares at the strike price of $6, so again, meaning if SoFi gets to $6 or above within the next month by December 9th, And the limit price here for the bid-ask spread would be right in the middle at 31 cents. 31 cents times those 500 shares would be $155. So if I went through with this trade today, that means I would earn $155 today that would go directly to my cash account. Here is the risk with selling covered calls. So what this does is this prevents you from getting any extra gain if the SoFi price continues to go up for the next month. So currently, right now, SoFi's trading at $5.83. Let's say I would go ahead and say, okay, I'm willing to, sell my 500 shares at that $6 strike price. Well, let's say we have that month's range to wait to see what happens with SoFi price. Well, let's say SoFi just keeps going up, $7, $8, $9, $10, $11. And now instead of being down, a certain amount of money, now I'm up $1,000, $2,000, $3,000. Well, here's the problem. Since I placed and I wrote that covered call, I don't get any of the unrealized gains. I don't get to see any of those gains because I agreed to sell my shares at the $6. So you were tied. You were stuck at that. Now there's different strategies. You can roll your options and do different things like that, which I'll talk about in future videos. But that is what the risk is of covered calls. You do not get to take advantage of the price appreciation once you have agreed to your trade. So again, just to re-explain that to you guys, if I come here and I say I'm agreeing to sell at $6, but then from here till December 9th, it continues to go above $6, I don't get to see any of those gains. I'm stuck with the $155 or whatever it was that I got in my cash account the day I made that trade. So something to think about whenever you're selling covered calls. Now let's move on to selling puts. So selling puts, again, and you have to have collateral with selling puts. Now instead of having shares purchased, like I did with 500 shares of SoFi, now I would need to have the cash as collateral. So with covered calls, with selling calls, it was saying I'm willing to sell my shares. Now with selling puts, that means I'm willing to purchase shares. So now let's say I don't own any SoFi. Actually, let's just do this. Let's go to a different stock that I don't own any ownership in at all. Let's go to the first one on my watch list. Let's go to Lyft. So if I go to Lyft, trade options, go to that December 9th expiration date. We have sell selected and put selected. Now I'm looking to be able to say, okay, I am willing to purchase 100 shares because each contract I purchase represents 100 shares. I'm willing to purchase 100 shares of Lyft at a given strike price. So let's say I'm willing to purchase 100 shares at the $10 strike price in Lyft. So I would click this. Let's just say I want to do one contract. Then I would do the bid-ask spread is 23 to 25 cents. I'd go right in the middle at 24. I would earn $24 in premium right now. Whenever I would execute this trade, that $24 would go right into my cash account here on Robinhood. And that would basically be saying I'm willing to use $1,000 of my collateral to purchase 100 shares of Lyft at the $10 strike price, because 10 times 100 is $1,000. So you have to have that $1,000 in your Robinhood account in order to sell a put. This is also known as selling cash secured puts. So you have to have cash secured in your account to be able to sell puts, because you have to say I'm willing to purchase these at a given price. So again, same example here. If I'm willing to go and say I am willing to purchase 100 shares at $10 of Lyft by December 9th, if it's at $10 or below, no matter where it's at, if it's at the $10 or below that price, I am purchasing Lyft for $10. So if come December 9th it's at $8, I still have to buy it at the $10 strike. I still have to use my $1,000 to own 100 shares. So let's click that again. Let's just go through this again. We're going to do one contract at the 24 limit price. That's right in between that bid-ask spread, and that's going to give me a minimum credit of $24. And again, I have to have $1,000 in my cash account, which I do not have here in Robinhood. I only have $280. So Robinhood would not let me execute this trade right away. So that is just something to keep in mind. If you're willing to sell puts, you have to have that cash in your account. So let's go look at SoFi again. If I wanted to buy more shares of SoFi, and I've been writing cash secured puts for SoFi, we go to December 9th or any date we want. Let's go to December 2nd, and I'm saying I'm willing to purchase 100 shares of SoFi at the $5 strike. Then I would need $500 of cash in order to make this trade go through. Okay, so there you have it. That was a very basic, elementary way to be able to trade options. Now, again, we went through buying calls, we went through buying puts, We went through selling puts and selling calls. When we are wanting to buy calls, that means we think the strike price is going to go up. If the strike price continues to go up after we've purchased our calls, then you make money. Now, for the exact opposite, if you're buying puts, that means you think the share price of the stock is going to continue to go down. If it does go down after you purchased your put, then you are making money. Now, selling options, again, is a little different. You have to have that collateral. Whenever you are selling calls, you have to have already an ownership of 100 shares or more in increments of 100 to be able to sell calls on a certain stock, and it has to be ownership within that stock. And then if you're wanting to buy shares of a company, which I will sometimes do this in companies I already know I want to own and purchase that day, but instead I will sell a put right at the money. Let's say I want to do a for SoFi at the strike price of 550. Well, then I would earn that premium. So if I am willing to purchase 100 shares or more in increments of 100 in a certain company, well, then I can come and I can sell a put. So I know it was probably a lot for today's video, guys. I recommend rewatching this a couple times to understand and make sure you really understand what you're getting into whenever you are trading options. Also, don't forget to check out that course down below in the description using code OPTIONS at checkout to get 50% off. We go a lot more further into detail, and you have lifetime access to the course. You can go back, watch videos, learn more about the Greeks. We also talk about the wheel strategy, which is a triple income strategy with trading options when it comes to selling options. That's a very excellent strategy that I use today and will continue to use to keep earning income whenever I am trading options. So guys, thank you all so much for watching. I really hope you learned something in today's video. If you got value out of today's video, please just hit that like button. That really does help out the video and the overall channel. Also, don't forget to get your 12 free stocks by signing up for Webull using the link down below in my description. Whenever you sign up for Webull, fund your account with any amount of money, you'll get 12 free stocks that could be valued up to $30,600, guys. It's free money, even if you don't use the platform. It's free money. Why wouldn't you do it? To get your 12 free stocks by using that link down below to sign up for Webull today. Guys, again, thank you all so much for watching, and until next video, you all take care. Cheers.